Today I want to talk a little bit about the loan estimate, and I'm going to hold it up here. We'll actually have this inside the article, but this is probably one of the most misunderstood and often underutilized documents that you will get during your process at getting a loan or a mortgage. And so inside of this loan estimate, this is one of the best things that happened post financial crisis when the mortgage industry went through a lot of regulatory changes. This loan estimate, which kind of looks like this, I'm going to let you take a look at it, should be provided to you every time or any time you complete a mortgage application. And a lot of times, again, it's kind of discarded or not thought about it. It is definitely an estimate early on, but it gives you a lot of information. If you're shopping for a mortgage, it is a perfect vehicle for comparing the mortgages that you're being offered by loan officers apples to apples. So when I say it was one of the best things that came out of the post-crisis, what I mean is that this loan estimate that I'm showing you, which is an example from the CFPB, which is a regulatory agency, is exactly the loan estimate in format that you will get from any lender that you talk to. And so when you're comparing these documents one to the other, they'll look exactly the same. So I want to show you a couple things that you'll want to look at when you get these, especially if you're comparing loans. So first and foremost, this is where most people get stuck or focus probably too much attention, and that's up here with the loan amount, the interest rate, and the principal and interest payment. And that's nice, and you want to find out what's going on there and make sure that it's consistent. But probably the most important pages are the next two pages. So this is the one that has all of the fees that go into making this loan, and you can start to get apples to apples. But before we go into the fees, I want to actually take you to the last page. This is probably the most important section. And this is, as it says, comparison. And it tells you right here, if you're trying to compare two loan estimates, again, apples to apples, you should compare these sections. Because what these sections are telling you is it says in the next 5 years, it will tell you the amount of principal that you will have paid off. It'll also tell you the total principal interest, mortgage interest, and loan cost. So it'll give you kind of an all-in cost that you can compare apples to apples. So it will also tell you your annual percentage rate, the APR, which is more important than sort of the displayed rate, because often there's fees that are inside of there that are not necessarily accounted for. This is your kind of fully loaded fees in interest rate, and then your total interest that you will pay over the life of the loan. So these, regardless of what anybody does with the incremental fees in here, these numbers can be compared side by side to figure out what is the total cost of that mortgage, and is it a better cost or a lower cost. Now sometimes that's not the most important thing to you, but at least you're going to make sure that you're comparing the loans together. Sometimes you want a lower interest rate, sometimes you want a lower payment, and as a result you might actually pay more for that loan over time. But again, by doing that, you'll be able to compare them side by side and apples to apples. The other thing I want to focus in on real quick, because this is where a lot of confusion comes in this section right here, in your loan cost, nobody does anything for free, neither do mortgage companies. And so this is where you'll actually have the cost of doing the loan. So this is your origination fees, your underwriting fees. So everybody that was participating in making this loan happen, this is where they get paid. However, you will often see, because most borrowers are very fee conscious, you will see next to nothing or a very low amount in here. And the reason for that is because generally, because of the borrower's request, because of your request, you've actually bought the rate up instead of what we often talk about buying the rate down. You've actually bought it up. You're willing to pay a higher interest rate so that you don't have to directly pay out of pocket at closing table the cost of actually doing the loan. And so a lot of times you'll see that with zero. So that makes you feel good, and sometimes that's exactly what you want. But if it's not what you want the actual lowest, you want a different sort of goal, you may not want, because that's going to increase the total cost of your loan over the life of the loan if you roll those fees in. But if you don't want to pay them up front, that's fine. You can roll them into the loan and that'll be zero. But there's a lot of misconception here, and sometimes loan officers will play games with this section to make you feel really good. But essentially, if it says 0 here, those costs are still getting paid. They're just rolled into the loan, which again is oftentimes your goal and what you've requested to do. But that's a good thing to check to make sure. Then after you do that, again, the rest of these things start to fall out of our control, really. So any mortgage company, most of these are going to be pretty comparable fees. So this first section are services they can't shop for, things that just have to get done, your appraisal, your credit report, and those sorts of things. Usually those fees don't vary much because they're direct pass-through cost. We don't make a profit on those. It's just whatever it costs us, we pass those through to you. Services you can shop for, but most borrowers don't, just because usually the lender gets you a pretty good rate on these, is things like title services. But those are things that you can opt to do with someone else. Or if you're purchasing, a lot of times you'll go with the seller's title company because again, they're giving you some sort of discount there. But you have some flexibility in here, but generally, again, in these two sections, the fees are probably pretty similar to any other lender. And then on the other side here, these things are, again, things that are really not controllable for the most part. It's the taxes that you're going to have to pay. It's the prepaids to pay for your escrow and those sorts of things, property ownership. Sometimes you can save a little bit on your homeowner's insurance. It's definitely something you should ask your lender about. Sometimes they have good relationships where you can get some discounts. And then as you go into here, again, some more title fees and stuff. But generally, there's not a lot of flexibility. This is really the only place where you're going to have some ability to kind of move around, whether you're buying up or down the rate. You can potentially affect the actual fees that the lender's charging. And then as you go down here, of course, you want to get to the bottom line of what's estimated cash to close. So super important document, especially if you want to shop. Make sure you lay these side by side. They'll all look the same and you can compare line by line and have each of your loan officers, again, if you're competing with multiple loan officers, they can explain every single line, or they should be able to explain every single line on this loan estimate and tell you exactly why it's there. And potentially, if you don't like something, how you could potentially change it or affect it, or maybe you can't. And then of course, this last one, the total cost of your loan, you definitely want to compare those apples to apples. So again, super good document where to get started. The other thing though I will leave you with is this is, as it is said, it is a loan estimate. So regulatory, there are certain things that cannot change, otherwise we'll get penalized and you get the cost covered. But for the most part, a lot of this could change, usually by the borrower's request or something being a little bit different than we expect. So if you change the amount of your down payment, you change the interest rate you want, or any of those sorts of things, any of the parameters of the loan, again, you'll get a new loan estimate, but potentially this estimate could be invalidated. So you will get a closing disclosure at the end, so you'll know exactly what the costs are before you go to closing. But again, this is an estimate initially, but it's a really good tool to figure out how much it's going to cost you to do the loan. The other thing is, get to this point. A lot of borrowers get really hung up on and anxious about filling out a loan application or a mortgage application. There is no commitment at that stage, but you have to do that and you have to get your credit pulled and those sorts of things in order to get to this point. Up until you get to this piece of paper, loan officers, and I'm telling you a little insider stuff, loan officers have all kinds of flexibility to sort of tease you about what kind of programs are available or what kind of interest rate you might be able to get. But if you do a full application and you have your credit pulled and you get to this document, now it's serious time. We as loan officers, as a mortgage company, know exactly what you intend to do, and we have clarity, and we can produce this document. Before this time, we're just talking all kinds of hypotheticals, and it's really hard for us to give you the most detailed and accurate information. And certainly, we're not going to be able to give you the best information for you to compare if you are shopping between different mortgage companies. So I really, really, really I want to recommend you filling out the mortgage application or completing a mortgage application with a licensed loan officer so that you can get this document and you can actually do your homework, figure out the true cost of getting a mortgage, and compare it as you're shopping. So encourage you, learn more about the loan estimate. If you have any questions, you can find us at velocitylending.com. Any of our licensed loan officers would be happy to go through excruciating details about a loan estimate and get that to you so that you can compare and see whether or not you want to get a mortgage or whether or not you want to refinance. So get to this point, the loan estimate, it's your friend.